Welcome back to another episode of the Meet Kevin Show. From 2 days ago in New York City with Kevin O'Leary to yesterday with Gary Black. Today, we are visiting who could potentially be the most famous bear on CNBC and Twitter. I think it is going to be so enlightening to have a discussion with you. And I am so excited to introduce Gordon Johnson. Yep. You have a research firm, GLJ Research. And tell the world, why are you such a bear?
Yeah, thanks. Thanks for coming. It's a pleasure to meet you. So essentially, we're bearish right now. We're not structural bears. I hate that we got that moniker, but unfortunately, that's what we have. Sure. The reason why we're bearish right now is because, and we can get into this when we talk about some of the other topics, but we've had essentially since 2009, we've had over a decade of artificially low interest rates. Yeah. And we've had significant, since COVID, and even before COVID, quantitative easing. Yeah. And we believe those macro factors are shifting. And we believe they have to shift because what's happened is inflation has now surged to a 40-year high. So the Fed is kind of their back is against the wall, and they have to act to fight inflation because, as Charlie Munger said, outside of nuclear war, inflation is the worst thing that can happen. So I think that the Fed has to act to fight that, and I think that's going to pull liquidity out of the market. I think that's going to be bad for stocks. That's the kind of overall view why we're negative.
Which makes sense, which is also why it looks like you hit on Nick T this morning. Yeah. He's the famous sort of Fed mouthpiece. Right. He seems to get the text messages from Jerome Powell, hey, leak this or whatever. Right. Jerome Powell seems to be really interested in these moving averages of what inflation is doing. And Nick T this morning mentioned that on a 12-month annualized basis, 12-month year over year, we're at 4.6% inflation, which I know you have some comments on because you tweeted it. Right. But what I did think was interesting to your point is that 6-month annualized, we're at 4.2, but 3-month, we're at 4.9, which feels like we're seeing some acceleration, especially in that more sticky travel, hospitality, people basically spending money on restaurants. Right. Is this going to become unsustainable? And is the Fed even able or equipped to fight that kind of inflation?
They're definitely equipped to fight it. And this is a great question, great setup. So with respect to Nick T, he does great work. I've told him that. I think the issue is he's using a seasonally adjusted index to make observations on annualized numbers. And if you talk to the Bureau of Labor Statistics, they'll tell you have to use non-seasonally adjusted numbers because you don't want those adjustments. And when you look at the non-seasonally adjusted numbers, specifically the index, non-seasonally adjusted CPI, over the past roughly 3 months, you've seen literally it shoot up. And in fact, inflation shoot up. And in fact, in 2021, if you look at the trend from about 1980 to 2020, it was a straight trend. And there's a couple of periods, 2000 to 2001, 2007 to 2008, where it kind of hockey sticked and then went back down. Sure. It's hockey sticking again. That started in 2021. And I think, again, the issue is all the stimulus money that was printed. Sure. So the problem is for the deflation crowd is we're seeing a resurgence in inflation. And in fact, it's really resonating in services inflation, which represents about 70% of CPI. Services inflation in the CPI number was 7.1% in the most recent reading. It was down from 7.3%, but I think over the past roughly 4 readings, it's been above 77%. We haven't seen that since 1983. Services is the sticky inflation that's really hard to get under control. So when you consider that, you consider that gas prices are going back up, right? Energy prices are going back up. What happens with inflation is, as we learned in the 70s, it rotates. You see it in services, you see it in car prices, then it rotates to energy, then it rotates somewhere else. And when you let that genie out of the bottle, as the Fed did, I think, people say the Fed's going to make a mistake. They already made a mistake, right? The mistake is 40-year high inflation, right? So when you let that genie out of the bottle, it's really hard to put back into the bottle. And, I'm really concerned. And again, Nick does good work, Nick T. But he's using seasonally adjusted numbers when he should be using non-seasonally adjusted numbers. When you look at the NSA numbers, the inflation looks actually worse.
Yeah, that's interesting because otherwise you're comparing how seasonal adjustments have changed. So now then the question becomes, we have all this mixed data. I mean, diesel prices are plummeting because of the freight recession, but gasoline prices are rising, like you mentioned. It almost feels like what you've described is this cancer of inflation, that it's here. Now it's gone from there. Oh, but now it's popping up over here, right? It's like metastasizing and showing up in different parts of the body. But my concern is with services, as you've mentioned, isn't there this potential that the Fed raises rates, but the people who are actually really driving the services spending, the average American, they don't necessarily care about higher rates.
Yeah.
Now, maybe that'll affect your credit cards, but if you're already in credit card debt and you're already paying 20% on your credit card, who cares if it's now 25%?
Right.
It really doesn't marginally affect your ability to spend or go on vacation because people are living paycheck to paycheck.
Yeah, good point. So let's use history, right?
Yeah.
It's hard to predict the future. In fact, it's impossible, but our job is to try, you and I.
Sure.
So the issue is every single time historically that CPI inflation has gone above 5%, it didn't come back down again
without a recession.
Until, not a recession, but until the Fed's funds rate went above CPI inflation.
Sure.
CPI inflation right now is sitting at 5%, right?
Yeah.
Core CPI inflation, 5.6%.
Yep.
The Fed funds rate is about 4.75. Powell had that prank call yesterday, and he said he's going to raise rates 2 more times. So theoretically, we're going to get to 5.25. But the problem is, you don't just need the Fed funds rate, historically, using history, to go to where CPI is. You need it to go above CPI. We're not there yet. So I think that historically, when the Fed raises rates, it has allowed inflation to come back down. And let's be honest. Really, what the Fed needs is they need a recession, and that's not. They don't want to admit that. And he said that in the prank call yesterday. But they need growth to actually decline. They need jobs to be lost, so you don't have all this strong economic growth. I want to go to my notes here.
Sure.
Consumer spending. So consumer spending data came out recently. It accounts for 70% of GDP. 1Q23, it surged by 3.7%. That was the biggest increase since 2021 during the stimulus money binge. And then you had government spending, which surged 4.7%. That's a new record high. So consumers are spending like drunken sailors, despite the inflation we're seeing. And that is very bad data if you're the Fed. And if you're somebody who is trying to fight this inflation, trying to make it by a normal person. We a lot of us talk about the stock market, but the statistics suggest roughly 80% of Americans are agnostic to what stocks are doing.
Right, exactly.
So the problem is the people who run things and the people who make decisions are so focused on the stock market, whereas the bulk of Americans aren't. And I think that's why I keep going back to this, but I think it's a great quote by Charlie Munger. The only thing worse than nuclear war is inflation. And I think the reason is because once that inflation gets to a certain level, we can look at, periods in history, like the Weimar Republic, the collapse of Rome, the collapse of Greece, all inflation driven.
Yeah.
You start, basically people can't afford food and they start to, basically push back. And when that happens, you have the fall of empires. So that's why we're so focused on this topic on Twitter and why we're so focused on it in our analysis. Yeah.
Now, what's interesting is this consumer spend explosion seems to be driven by, you had mentioned consumer spend for the first quarter up 3.7%, seems to be driven by what last year was a decline in people's personal savings. They were starting to go through the excess savings they accrued during the pandemic, which gave them around maybe on average 2.5 times as much cash as they previously had. But that had started declining in 2022, but now in Q1 it started rising again.
Right.
So this idea that, eventually people are going to run out of money, when does that actually happen?
That's a good point.
Now their savings
That's
are going
up. Great point. So I think there's a dynamic happening, and I don't think a lot of people have thought about this. Think about this, right? So for the past, since Obama, right, the Fed has been artificially repressing interest rates, right? I think a lot of people will agree that they kept rates too low for too long. So think about this. You put your money at Chase, and they're giving you 0.5% on your money, right? You buy a 10-year bond. The 10-year bond was yielding less than 1% for a long time. Now, all of a sudden, you're getting 4% on your savings, right? Sure. Every American, not just the rich. You buy a 10-year bond, you're getting 5%, or now it's 3.5, but it was up to 4. But you buy a 1-year bond, you understand
it's way higher now.
The point is, there's a new source of income for everyone that they haven't had for a decade, and that is interest rates being higher. Higher rates are bad for people like you and me who are investing in the stock, who are long stocks.
Exactly.
But it's great for the average American because now you actually get paid on your savings. So I think the reason why you're seeing this strong consumer spending is because interest rates have went up to the point where people feel more wealthy. The problem is, again, the Fed needs to take interest rates above CPI inflation. So they're fighting it, but they're not fighting it enough. And as a result, people are out spending more. I think that's why banks have been strong.
So that potentially could explain why we're starting, at least in these latest U of M surveys on inflation expectations.
Right.
It seems like some of those expectations are starting to rise. We used to be at a 1 year expectation of around 3.6. 2 weeks ago, and it just came out this morning too.
I think it was 4. It was above expectations.
4.6. So 2 weeks ago we were at 4.6, and it was a shocker. That's the preliminary read. The final just came out 23 minutes ago, and 4.6.
Yeah.
So it reiterates this potential de-anchoring of inflation expectations, which suggests the Fed has a lot more to do.
Right.
How high?
I don't know, but I think that, if I want to talk about this, the Fed. Can we talk about this?
Please, absolutely.
Just real quick. So, look, this may incense a lot of people, but I think this is the most reckless Fed we've ever seen.
Oh, wow.
Let me explain. Okay. So over the first 100 years of the U.S. Federal Reserve Bank in the United States, their balance sheet grew by roughly $1 trillion. It was about $974 billion. That's the first 100 years, right? So when COVID hit, initially their response was a $2 trillion monetary stimulus.
Yeah.
And you know what? We were looking at a black hole, right?
Yeah.
So I understand what they were doing. But then when COVID hit and we did $2 trillion, 6 months into COVID, retail sales were 15% above trend.
Yeah.
When we had the global financial crisis, it took retail sales, I think, 8 years to get back to trend.
Yeah.
The 2001 collapse, I think it took 12 years to get back to trend. COVID, that recession, it took only 6 months, and we were 15% above trend. In addition, we had vaccine confirmation. So after we were back to 15% above retail sales trend, and we had vaccine confirmation, they continued to stimulate. They did another $2 trillion. That's 200 years of stimulus they did in like 2 months. Yeah. That is completely reckless, right? And then they said, we're not going to forecast when they were doing all this stimulus. And then, as me and a lot of other people who were historians of the market were saying, we got the crazy inflation, right? And what's crazy is they were essentially making a 30-to-1 bet on this, right? They were trying to get, so inflation, you had CPI inflation at 1.7%, right? They were just trying to get to 2%. And to do that, they were doing this crazy stimulus. Now, the problem is if they lost on that bet, it wasn't them who lost, right? It's poor people. Sure. I think the stock market for the next 10 years, I think, is going to be stagnated. So my point is these guys have proven to be reckless and be wrong with the transitory comments, et cetera. Yeah. But then with SVB, and I want to talk about, hopefully we can get into the bank crisis. But with SVB, right, you had a bank doing very bad things. Clearly, other banks had, in 2022, had, adjusted their, risk assets and duration to match what the Fed. Fed was hinting they were going to raise rates. So, and instead of letting them fail, the Fed comes in and over 2 weeks does $400 billion of not QE. We think it's QE, but a lot of, so, that's like 50, what was that? Like 50 years of balance sheet expansion in 2 weeks. So, this isn't an instance of, courage from Jerome Powell. Sure. So I'm concerned, and we could talk about gold, because I'm concerned that when things get tough, he's not going to have the courage to stay the course on fighting inflation. And that could be quite concerning.
Oh, wow. I mean, this is a lot to unpack there, and really, really insightful, because you're right. Rates, we were printing over this last decade before COVID, because as you said, inflation was running below trend. We were at 1.7, and they were trying to get us to 2%. There was even talk about lowering the inflation target, which sounds insane today, but lowering the 2% target to 1.75 because they just couldn't get it up. Which makes the question then that comes from that is that because of this 40-year disinflationary trend of technology, or why were we able to print so much money then and not see inflation? Right. And then, of course, we can talk about the mistake of now.
That is a great question. I'm sorry I keep saying that. Yeah. So the issue is there were two types of inflation, right? You have inflation of the monetary type and you have inflation of the fiscal type, right? So with Obama and through, essentially until we got to COVID, really what you had was monetary inflation. And that's the Fed essentially doing quantitative easing, right? We did the MBS bailouts. We were supposed to bail out the housing market, and then they just continued to do it. So you say we didn't see inflation, but you did. The problem is you saw it in stocks and homes, house prices, right?
It's that cancer analogy again, somewhere else. Not to be insensitive, obviously, but...
you saw it in stocks and houses, right? Home prices have went from, I think, an average of like 200,000 to like 400,000. Now they're coming back down. But, over that same time frame, minimum wage hasn't moved. So you've essentially priced an entire generation. You look very young. You're probably in that generation. You priced an entire generation out of the ability to buy homes. Normal people, right? The bulk of Americans, not the well-off. So with COVID, right, Congress got into the mix. And the Fed was extremely reckless. They were doing all this stimulus, but Jerome Powell urged Congress to join in.
Sure.
So and keep in mind, right, the U.S. government can't do stimulus without the Fed printing. So people are blaming the U.S. government, and they should, but they can't do it unless Powell prints that money out of thin air. So what you had the fiscal stimulus, right? You had literally helicopter money being dropped to people, checks. And so that's when you had the inflation and everything else, right? You just give people checks, they're going to go out and buy. So that's when you had the outside of homes and stocks, you started to see inflation everywhere else. And again, once you let that genie out the bottle, we've seen historically, it's extremely hard to put back in the bottle. So that's why I say, and we can talk about this more, this is the most reckless Fed we've ever seen.
Wow. I mean, that's fascinating because really you're suggesting we've always had this inflation during the QE regimes. Right. It's just shown up in asset prices rather than in nominal inflation for your groceries or normal services. Whereas now we've had this massive acceleration in money printing during the COVID era, which I agree with you. I mean, looking back, if we had the vaccines approved, 5 days after the election or so, November 9th of 2020, right around there, 7th, 9th, why did we print until March of 2022?
Right.
When inflation was already 6 or 7%?
We were screaming via Twitter and however we could. We don't have the exposure you do, that we can't believe what the Fed is doing. And people say, well, you're just trying to support your short position. No, I care about America.
Sure.
The issue is, if you look at any major crash of whether it's an empire or a major crash in the U.S. economy, it follows a bubble. And the Fed has built via unnecessary measures the biggest bubble in essentially everything. People have referred to it as the everything bubble we've ever seen. And what a lot of bulls would say, well, what's different, right? They've been doing this since 2009. What's different? Here's what's different. Right? Again, I think people say the Fed's going to blow something up. I think they already did blow something up, and that is prices, 40-year high inflation. So the problem is they've blown this bubble, and the Fed's core goal is to keep prices steady. Right? That's essentially why the Fed was created. It's not even really jobs. The Fed was created, central banks were created to keep prices steady. Clearly, prices aren't steady. So the problem is they've blown these massive bubbles, and now that we have 40-year high inflation, they have to fight it. And so as those bubbles burst, when bubbles burst, you have, essentially recessions/depressions. And that's kind of why I think people should be concerned/scared.
Yeah, you refer a few times now to almost comparing America to potentially the Weimar Republic or empires collapsing.
Yeah.
Is it going to be that bad?
I hope not. I don't think we're too far past the pill, but it really concerns me that what the Fed did with SVB, doing the $400 billion of balance sheet growth in 2 weeks, because that showed a lack of courage, a lack of willingness to fight inflation. So the concern I have is when the going gets tough and the stock market drops 2%, I'm joking, but you understand when anything happens negative, and I want to talk about SVB because those guys should have been let to fail, and the depositors would have been fine. But when anything bad happens, I'm concerned this Fed's going to come in and do just massive stimulus again. And that could lead to an even bigger collapse later.
Well, let's talk about that. Let's talk about the banking crisis and stimulus, because I have to say I was really I found this picture very exciting that you put on Twitter. Okay, this right here. Your caption is in medieval Spain, bankers who became bankrupt were publicly disgraced by town authorities and given nothing but bread and water to eat until the creditors were paid off.
Right.
After a year, if the bankers failed to pay them, they would be beheaded and their property and assets would be sold off.
Yeah. I don't want to say I think bankers should be beheaded, but I do think that, if you're able to make a lot of money doing bad things, you should also be able to be allowed to fail. Let me talk about essentially what happened. Do you mind if I read from my notes here? So essentially, what you had with the failure of SVB, Signature Bank, Credit Suisse, and any others, it's the fault of the Fed for doing 14 years of interest rate repression, quantitative easing, and essentially turning the bankers' brains into mush. And what I mean by that is, and you also had bank management for not taking the Fed's advice and preparing for higher rates, instead operating recklessly in order to get, higher bonuses, moving their stock prices higher, versus Brazil and Mexico, by the way, who hiked rates sharply in December 2021. The Fed was telling you we're about to start hiking rates. What did Brazil and Mexico do? They hiked rates significantly to prepare for that in December 2021, or the right thing to do. So you had SVB, Signature Bank, Credit Suisse, and others who engaged in stock pumping schemes to boost their equity prices, which resulted in very nefarious and likely illegal activities. Keep in mind, at SVB, what they were doing is offering below market rate loans to startups who weren't making any money, no earnings. And the quid pro quo was those startups had to keep their cash at SVB. That's a bad business practice, right? That's just nefarious business activity. So when you get caught out there with your, when the tide goes out, we see who's not wearing shorts. That's a Warren Buffett quote, right? The tide went out. They should have been allowed to fail. And keep in mind, everybody was talking about, oh my God, the depositors, and we found out later, right? It was like, guys who had billions of dollars. So these weren't, small businesses, but also keep in mind that, these depositors, would have been made whole, right? The depositors, it happened over the weekend. That Monday, they would have been made whole 90 cents on the dollar, right? So this idea that all these, small businesses were going to lose money was always wrong. And when you bail these guys out, right? When you allow these guys to engage in nefarious and credibly alleged illegal activity, you basically encourage moral hazard. So when you do that, you essentially encourage other banks to do the same thing. So I think what Yellen did and what Powell did, I think was bad. And I think, it's all funded by the taxpayers, FDIC, Treasury, et cetera. The government is funded by the taxpayers. So that's why I put that quote up, because you're not holding these people to account. And these people did extremely nefarious things. And we have examples of banks who took the Fed's advice and raised rates. They changed the duration of their asset mismatch. Not just Mexico and Brazil, but also banks in the U.S., J.P. Morgan, Bank of America, et cetera, when these banks didn't. And so these banks should be held to account.
I think this is so fascinating because really what you've suggested is that Jerome Powell was weak in 2020 when we had the vaccines, we had retail sales above trend, we had already won. Right. Why continue to spend money? And now he's acting tough. Oh, we're going to stay higher for longer. But as soon as one thing goes wrong, that's it. 100% bailout of the banks, essentially, which was taxpayer backed. Ultimately, I think FDIC will end up distributing the $20 billion, $22 billion of loss to other banks. Really corporate socialism to some extent, which I think you've referred to as well on Twitter. So the question then is, if he was weak in 2020, if he's weak now during the banking crisis, it sounds like you're thinking he's going to be weak again and we're going to see printing again and stimulus again, which potentially means inflation again. Can you speak to that?
Yeah, so I think you phrased it perfectly, which is why, again, everybody positions us as bears. But if you don't have faith in Jerome Powell, you don't have faith in Joe Biden from a fiscal responsibility perspective, and they're going to basically print, which is going to decrease the value of the dollar. What you want to do is you want to own gold. Right? If the dollar falls in value, gold is going to increase. Not just gold, but other precious metals and potentially other commodities. So that's why we're bullish gold. We own gold. We like gold. And I think it's because you have a Fed chair and a U.S. president who are willing to spend hundreds of billions of dollars in the face of 40-year high inflation, which is extremely scary if you love this country. Because again, it's like every time I talk about inflation, there's these guys on Twitter who say you're just talking up your Tesla position. No, study economic history. I went to school. I studied economic history. A major in finance, minor in economics, Morehouse College. If you study economic history, inflation is extremely scary. I think Munger, at over 90 years old, he knows what he's talking about.
So, do you think we're going to return to stimulus checks then? Or how is that inflation going to come back? Where's the weakness going to manifest? Like, how are we going to see it?
Right. It's hard because if you look at the history of inflation, the last time we had inflation like this was in the 70s. And what you see with CPI, it's like this, right? So you'll think you got it under control, then it rears its ugly head. You think you got it under control, it rears its ugly head. And, everybody credits Paul Volcker, rightfully so. But if you remember initially, he didn't raise rates enough. And
Right.
inflation
1980,
rates,
and then you had to come up again.
And then he had to, at one point you had mortgage rates at 15%. You were able to invest in a bond and get 13%. So I don't know where we're headed, but I think that what is being done now is not enough. And I think that, again, because rates were zero for so long and now they're, on certain bonds, 1 year, 6-month bond, you have near 5% rates. I think that's why you're seeing an increase in spending, because people have more money on their savings and they feel like they have more money, and they do.
Sure.
But I don't think they're doing enough. And you can see that evidenced by the strong economic activity, the strong labor market, the CPI data today, the data we talked about, the non-seasonally adjusted data, which is now spiking back higher. So I don't know what we need to do, but it's definitely more than what they're doing. And, they have not been a image of courage, if you will, with respect to some of these issues we've had.
Do you think the depositors should have taken that 10% haircut you mentioned? A quick reminder to check out my wonderful programs on building your wealth, linked down below. I regularly add content to them. I go live every single day with course members, providing not only my commentary, financial analysis, real estate analysis, but I answer your questions. There are multiple different avenues you can check out. You could start with the 0 to Millionaire Real Estate in the Stocks and Psychology of Money group. Phenomenal baseline knowledge to really build your wealth. Check out the Elite Hustlers course to grow your income as an entrepreneur, making sure you're negotiating those higher wages as an employee or protecting yourself as a business owner. Make sure you check out the Real Estate Agent course if you're an agent, the YouTube course if you want to build your social media following. So all of those linked down below. I would love to see you as a course member. Soon, we'll also be doing free house visits to random course members within the course, whoever wants to, and we'll be exploring what your financial journey has looked like. Check it all out, linked down below.
Absolutely. Absolutely. I mean, they would have gotten that day, and then they would have been made whole later. But we now know that I think it was like 10 depositors that had billions of dollars. So initially,
Circle was one of them. I think they had $3 billion.
Right. I don't know. Yeah. But the point is, it wasn't small, businesses that, we were going to see massive labor cuts. These were like Silicon Valley billionaires who had, who essentially bailed out. And these were guys who knew what they were doing. Like when you look at some of these VCs on Twitter who talked about some of the deals they got from SVB, I mean, it's crazy. They were getting below market rates. They were getting sweetheart deals on mortgages, et cetera. These are guys who should not be bailed out.
And all of a sudden, it's the VCs and potentially like the Gavin Newsoms of the world who were also a big voice in forcing this essential backstop. Right. Potential conflict of interest there.
I mean, it's just, it's infuriating when you think about it, if you understand what's going on.
I think it's fascinating that you you criticize Paul Volcker. Generally, people don't go there. People seem to honor Paul Volcker. Right. But you mentioned that, I mean, he got in 79. He had a recession in 80 because they didn't raise rates even enough. Right. And that didn't tame the inflation that they needed to raise rates again for, starting, I think, in October of 80, all the way through 82, to actually get inflation under control. So everybody holds him up on a pedestal, but even he was not certain with what to do.
Well, no, I do hold him on a pedestal. He did something amazing. And keep in mind, at the time, I think Carter was behind him, but there were a lot of pundits out there in Congress, both the House and the Senate, and TV pundits, et cetera, who positioned him as the devil, and he held his ground. He is a man to be revered.
He had the courage.
He had the courage. So no, I just what I meant to say is initially he didn't do it, but he did it and he stuck with it. And he's a man that should be revered because I think he saved America from years of stress. And if you look at what this Fed has done, I mean, think about, let me finish that thought. If you look at what this Fed has done, it's the opposite of that. Think about this, right? Think about this. So Janet Yellen, right? So in 2021, right? When the 10-year bond was below 1%, instead of issuing debt to fund the U.S., she was running down the TGA. Now, the problem is when you run down the TGA, not the problem, the benefit is if you're long stocks, that's like QE. What we look at, a lot of people talk about the Fed balance sheet, but you also have to look at the Treasury General account balance and the reverse repo account balance. When she runs down the TGA, that's a way to effectively stimulate the economy.
That's liquidity,
But, the problem is she could have issued debt, 10-year debt at below 1%. That was just reckless. It was reckless.
Not to issue debt at those numbers was reckless.
It was reckless. And, so the last time she ran down the TGA and then she had to run it back up, it was, I think it was December 2021 to May of 2022, right? She ran down the TGA, she had to refill it. Now keep in mind, when she refills the TGA, what that means is she has to issue debt into the market. So she's pulling liquidity out of the market. Guess what happened? December 2021 to May of 2022, S&P down 17.5%, right? So now we're at a point where, right, the TGA got all the way below 100 billion, right? Tax season, we're now at, I think we're like 270 billion. She's doing about 50 billion of rundown a week. So that means she has about maybe 4 or 5 weeks left before she runs out of money. So over the next month, she's going to run out of money. The debt ceiling is going to be compromised, and then she's going to have to refill the TGA, right? Treasury General Account Balance. She's going to pull liquidity out of the market, where at the same time the Fed is doing QE. Last time she did that, the S&P fell 17.5%.
Right.
Correct.
Yeah.
They're doing QT. Yeah. I'm sorry. Correct. Sorry. The Fed is doing quantitative tightening, not quantitative. But the last time she did that, right, the Fed was doing QE, right? The Fed was, pushing money into the market. Stock market still fell 17.5%. Now she's going to have to do it, and the Fed's doing QT, right? They're pulling money out of the market. So I don't know how much the market's going to fall, but it's things like this that I think some of our sell-side peers aren't focused on. And I understand it, but you have to be focused on the macro in this environment.
Oh, yeah, absolutely. Yeah, I think this is so interesting, the idea of refinancing or having refinanced the debt lower. It reminds me of, I believe it was Donald Trump, who was saying we should take out 100-year treasury bonds now because we could do it for next to nothing.
Right.
I mean, now in hindsight, that would have looked like a brilliant idea.
Right. He wasn't all bad. And I don't want to get political at all, but one thing I would say, though, is he was pushing Powell to cut rates. And I think it was 2019, Powell cut rates 3 times with unemployment at a 50-year low. That was a huge mistake. You don't do that when things are going well. You do that when things are going bad. So again, another instance of him not having the courage to do what's necessary.
The rate futures market right now seems to be convinced that we're going to get around 2 percentage points of cuts by December, January, after maybe hitting that peak of that 5.25. Do you think that's realistic, or are we going to sit at that flat line for a year?
Yeah, I'm willing to bet you a beer that's not going to happen. I'm joking, but no, absolutely.
A Bud Light or like a Stella?
I don't want to go there. What I'll say is, you just look at where inflation is. You look at the trends in inflation going up. You look at the strength in the jobs market. You look at the strength in consumer spending that we talked about. The idea that the Fed is going to cut rates, I think, is ludicrous. And I think the rate market will have to adjust accordingly. What Powell said with the prank from Zelensky, the fake Zelensky, which we now know was real, he said we're going to raise rates 2 more times and keep them there for a long time. Look, believe what he's saying. Look, I was a guy who fought Powell, right? Don't fight the Fed. I fought him for a year and I lost tremendously. Look at Tesla in 2020, in 2021. I fought him and I lost. So for guys who are saying we're going to have rate cuts, you're fighting what he's telling you. And I don't think that's smart. I think you should believe what he's saying. And if you believe what he's saying, rates are going higher.
Is it possible
and they're going to stay there.
That the reason maybe people are fighting that is the idea that the Fed can't today say that they're going to cut rates in December because then people will pull out debt and go right back to spending and they'll reanimate inflation and we truly won't get there. Whereas if he pretends to have this hard face of we're going to, higher for longer, and then we get to December. All right, we're going to, cut margin. Is it an expectations game? Is he playing with us? Because you actually tweeted about how Jerome Powell seems to be more transparent in this prankster call than he is with the American people. Is he playing us?
I don't think he's playing us. I think, but in the prankster call, he said what he's told us, right? He said, we're going to raise rates 2 more times.
He said in 1 minute what takes probably 20 press conferences.
Right, I agree. I think they should stop with these speeches. But he kept with what he's been telling us, right? He's saying, I'm going to raise rates and keep them there. He said that in the prankster call. So I don't think he's trying to play us. I think he's being honest. And let me tell you why. So it's the data. If you look at services inflation, services inflation sitting at, hold on, let me see here. So we got, let's see, core services inflation, right? The number that just came out. Core services inflation without energy services jumped 7.1% from a year ago in the most recent reading.
Is that CPI?
That's CPI, yeah. The core services CPI. And that was 7.3% in February. So this was the 4th month in a row of 7% plus core services inflation. It's the highest we've seen since 1982. That has to be scary to the Fed. You look at energy prices, which are going back up. You look at core CPI, which is sitting at 5.6%, right? Their target is 2. That's their measuring stick. So the reason why I think he's serious is because the numbers are too high, the numbers are sticky, and they're not coming lower. So if he's serious about fighting inflation, which I think he is, then he has to do what he said he's going to do. And again, he reiterated that with the fake Zelensky.
And that's the higher for longer.
Correct.
Okay. Now, PCE this morning, those numbers, I want to pull the services figures here. It seemed like services came in at expectation, core services. And we know PCE runs lower, just the way they measure it.
Right.
Is it possible that we really did peak in June of 2022, and that, yeah, maybe it'll take longer to get these numbers down, whether it's CPI or PCE, but in a year from now, are we going to be at 2% inflation? Are we going to get it down?
I hope so, but the data just doesn't support that right now. Again, this services inflation is sticky. Core services inflation minus energy is sticky at 7%. That's roughly 70% of CPI services, and it's not falling. And you also have now energy prices going back up, right? Biden ran down the SPR, right? Strategic Petroleum Reserve. So what happens when we have to refill that? What happens if OPEC continues to cut, right? We're going into driving season. Oil prices, but more importantly, gas prices, which have a hugely high correlation to the energy component of CPI. We did the math. I think it's around like 85%. If you look at just retail gas prices against the energy component of CPI, the R-squared correlation going back multiple years it's like 85%. So as gas prices go up, that component in CPI is going to go up. And that's been a key driver of the downtick, right?
That's a way of saying you could sort of see a leading indicator of what CPI is going to be just by looking at gas prices, which have been coming up. Not to be confused with diesel prices coming down, but gas prices for normal Americans going up.
If any of your viewers want to just do this analysis, it's very simple. Look at the energy component of CPI on a monthly basis. Go back about 10 years. And then track that against retail gas prices, which we get daily. And you'll see that the R-squared correlation is nearly perfect. So the fact that those prices are going back up has to be scary to the Fed if they're looking at this data, and I'm sure they are. So the idea that he's going to, quote unquote, pivot, I think is, I don't know a better word than ridiculous. I think it's just not going to happen.
What about this de-dollarization? We've lost some clout in the Middle East, potentially a lot of talk about now Saudi Arabia and Iran partnering, and they used to be mortal enemies now with deals negotiated by China. Are we losing the strength that we once had, the soft power strength that we had, and are people respecting America less and trying to move away to different alternatives? Or is this just the same story we've heard before?
Yeah, that's a great topic, and currencies is one of the hardest things to predict. I am definitely not better than anyone else out there. But what I'll say is, I think there's two different things to focus on here. Number one, the idea that we're going to move to some other reserve currency, I think, is ridiculous. Still, I think roughly 60% of the world's reserves are in U.S. dollars. The United States, despite all its problems, is the most stable democracy in the world. You look at China, where you have a dictator who's running labor camps and slaves, and look at what happened to Jack Ma. It's not a real democracy. You look at Russia. I don't think I even need to talk about that. They invaded a sovereign nation. You think about some of these others. So I don't think there's risk of us moving to another reserve currency anytime soon. What I will say, though, is if Powell is reckless, which scares me, I think the value of the dollar could decline significantly. And if that happens, you're going to have inflation in the United States that brings a lot of people to their knees if they're not already there. So I don't think there's risk. I think that people are just playing. This is something we've heard for years. We're moving away from the dollar. Just look at the numbers, right? Reserves, again, U.S. dollar 60%. Our democracy is the strongest. You don't have people, getting in boats in the U.S. trying to get into China. You do have people getting in boats in China, going through Mexico, trying to get into the U.S. We're still the best, and I'm a patriot, so add that to this. But we're still the strongest and the best country in the world, and that psychology has a lot to do with the strength of the dollar. So I don't think there's any risk of us moving, but I do think there's risk of them printing a lot of money and devaluing the dollar. And if that happens, I think you will have a lot of people here that are brought to their knees.
And that is true, by the way. You're getting an awful lot of an increase of Chinese nationals coming in through the Mexican border. Very interesting. Okay, now we have to talk about Tesla. So when are you going long Tesla? Do you own a Tesla?
I do not.
Have you ever driven a Tesla?
I'll show you the cars I own. I have. I've driven one. I actually drove the Man, this is a great story. You won't believe this.
Okay.
So this was like 2000, I think it was 9 or 10.
Okay.
And I remember, I forget the IR guy's name at Tesla, but I was out
Martin.
doing like,
I
think it was different.
It was different then. He started.
But I remember, I was out doing like some solar meetings in California, and the guy said, "You got to come to our plant." And he let me drive the Roadster, and it was like driving like an electric go-kart.
Yeah.
It was really fast, and I went to their plant, and there were no cars being made. And I was going to initiate on the company with a buy. I swear, it was when it was $35, and
15 split ago.
Yeah,
1 to 15
so it
split
would
ago.
have been 15.
Yeah.
And a couple of my clients were like, if you initiate on that stock with the buy, we're leaving. And it's not that I let that influence me, but it kind of influences. So I said, you know what, I'm just not going to touch it. So that's an interesting story. And it wasn't that I was extremely sold. I didn't even meet Elon. It was just, I was just like, this is a new product, and people like new products. Anyway, so to answer your question, get back to your question, what would get me to buy Tesla? Look, I think the stock is worth $24.33. And I know that sounds crazy, but I'll tell you this, when Tilray was at 300, I think we had like a $40 target, and people said you're crazy. When Sun Edison, which went bankrupt, we had a buy rating at 30. They did this deal with Vivint, and we took our $30 price target down to $1 when the stock was 19. People said you're crazy. In First Solar, I remember this is back in 2009 when the stock was like $230. I think we had a $40 price target. People said you're crazy. Look, I think that's what the stock is worth. When it gets there, we'll reevaluate. But I think there's a lot of issues which we can get into. Are
you using sort of the industry average multiples?
No, we're using a I actually think that the numbers we're using, so to answer that, we're using a 20-year DCF.
Okay.
Projecting out cash flows, discounting those cash flows back to the present.
8% or something?
We're using, I think the discount rate we're using is around 8%. Okay. Yeah. Okay. But so, and what I'll say is the assumptions we have in our model to get to $24, I think are pretty aggressive.
What kind of volumes are you thinking?
I think we have them getting to like 10 million.
Okay, so you actually have them getting to 10 mil.
Right.
But your DCF is still putting them at 24 today.
Correct.
That's scary.
Right, because the thing is, think about this, right? So Tesla did what, 73 cents in Q1. Yeah. You multiply that by 4 and divide it into the stock price today. You're talking about just under a 60 times multiple, right? The industry trades at 7 times. This is for a company who effectively cut prices roughly, I think it was like 10% in Q1, yet saw volumes grow just 4%, right? That means they're cutting prices and they're not seeing the elasticity. Think about this. What if Lamborghini cut their prices by 20%, right? Or forget about Lamborghini, Porsche. Sure. Or, you understand, people would be running to the dealership, right? If that $200,000 Lamborghini, the elasticity would be massive. So the issue with Tesla is very simple in our view. You have a company who, over the past 4 quarters, has produced more cars than they've sold. That's a record. You have a company who's cutting prices, and you're not seeing the same increase in unit volume that you're seeing in price cuts. That's a big problem. You have a company who, in our view, is the BlackBerry of EVs, i.e. they're the first guy out there, but now you have all these guys coming in with cars that have equal or better real-world range, better interiors, and real service ability, and a long history of being able to make it. Tesla's never been through, it's a frontier asset essentially. They've never been through a full business cycle. So I just think that there's significantly more downside because you have all this competition, and it's not necessarily Tesla's fault, right? Think about this, right? The cost of capital, right, over the past 3 years, think about 2020, 2021, early 2022. If you said EV, you could go raise billions of dollars and create a car company out of thin air. But the demand for those cars increase, right? You have all these new car companies, all these new EV car companies. But like, are there more people to buy the cars? So what I think is going to happen, we highlighted this last year, is inevitably you're going to have a price war because it's just supply demand. If you have more cars, same amount of demand, you're going to have to cut your prices to move those units. And because Tesla's the first guy in there, they haven't really invested in R&D to, come with new models. Every car company, new models every 1 to 2 years. Tesla's essentially had the same models since inception. And I think that's a problem. So you have all these issues. You have the issue with, specifically Elon Musk around, the full self-driving. He's been saying we're going to have full self-driving next year since 2014. You have, all the things he's done, the fake solar panels he did to sell Solar City, filing a 13D instead of a 13G, clear violation of securities laws to acquire Twitter, the things he's done on Twitter, forcing his workers back to work in California at the height of the COVID crisis against a county order. And calling a hero a pedo, and a number of other things. So I think that's, upset, if you will, some of his buyers. And we've said this before, in a lot of instances, having a Tesla car now is analogous to wearing a red MAGA hat. And I think that, his core constituency was, on the liberal side. And I think now that he's kind of, whether it's true or not, moved over to the conservative side, I think that's hurt him too. So there's a fundamental aspect, and then there's a quantitative aspect, and there's a qualitative aspect. Both, I think, are working against them. And if you look at what's happening in China, I mean, so far this quarter, we just put our China note out. The numbers came out early this week. You've had 6 boats go from China to Europe. Last quarter, over the first 26 days of the quarter, you had 13 boats. So significant decline in boats to China. So the sales domestically in China are better than they were last quarter, but they're not significantly better, despite the fact that you're not having all those cars produced go to Europe. That's a big problem. They're just not selling the cars in China they need to. That also suggests the demand in Europe is weak. You saw it today. Again, they cut the Model Y 7-seater by another $1,000. That's the 7th price cut in the U.S. this quarter. And yet and still, their inventories are going up. Look, this is just a company that has too much capacity versus demand. I think they've reached saturation, and the competition is coming and coming heavy. So I think that, I think our price target is going to prove accurate. When it hits our price target, we'll reevaluate. But, we don't hate Elon Musk or hate Tesla. It's just we think the stock is grossly overvalued. And when it gets valued accordingly, we will reevaluate. But it's not a tech company, right? They're last in FSD. They're buying batteries from CATL and Panasonic. All the promises they made at Battery Day were essentially mistruths. We now know that the battery has the 4680 battery they made is actually worse from a technological standpoint than existing technology. So they don't have any technology either. So I think once it gets valued accordingly, we'll reevaluate.
Have you tried FSD?
I am scared to try FSD. I have not.
Okay.
I have not.
And
I've seen the videos, and I know every experience probably isn't like that, but I've been in a pretty
the Dawn videos, the Dawn.
Well, I've been in a bad car accident, and I'm just once you're in a car accident, you're not willing to risk your life for technology. Yeah.
What about which companies do you think are beating Tesla in FSD or even regular competition? You mentioned
Right.
Tesla might be the BlackBerry. So which other companies?
Yeah, so Guidehouse ranks autonomous driving technologies, and they rank Tesla dead last. There's probably 20 companies they rank, if not more. The ones they have at the top are Waymo and Cruise and Mercedes and BYD. Literally, Tesla ranks dead last. So when you say which companies are beating them in FSD, according to Guidehouse, who I trust, everyone. With respect to cells, right? BYD is crushing them in China. VW is beating them in Europe. And in the US, we now know that over the first 2 months of this year, their market share has fell from 75% last year to 50% this year. Keep in mind, GM's not even really in the fold yet. They're coming with, I think, like 15 new EV models this year. It's not the GMs and the Fords who are beating them. And on CNBC, a lot of people like to say, but look at Lucid, look at Rivian. I think that's cherry picking. The guys who are beating them here are Toyota, VW, Mercedes, etc. Hyundai. Those are the guys who are taking share from Tesla and beating them in the U.S. So I think that the numbers just tell the story, and I think that with these price cuts that aren't working, I mean the proof is in the pudding.
Toyota's CEO recently said that they believe they're part of the silent majority of people who are interested in hybrids instead of fully battery electric vehicles.
Right.
Shortly after he said that in December, he announced his retirement.
Right.
And now the new CEO is talking about moving to all battery electric vehicles, and they're talking about a new lineup of BEVs. Is potentially Tesla just early here, and these legacy companies realizing, wow, we actually have to catch up with real battery electric products where we really haven't yet?
Yeah, I think that again. I think they were early. I think they had a first mover advantage. I think that when we had the part shortage in 2020 and 2021, I think they were willing to cut corners that other people weren't with respect to some of the chips they qualified in within months, where usually it takes 2 years, et cetera. We highlighted all these issues. Nobody seems to care, but now you're starting to see some of these cars. I think they have the most amount of their cars are recently ranked the most likely to be recalled. Consumer Reports has Tesla ranked nearly dead last on quality/performance. JD Power the same. What question mark, which is a rating outfit in the UK, the same. They rank Tesla's cars literally. What question mark is dead last in quality performance? JD Power and Consumer Reports either dead last or second or third from last. So again, this isn't me saying this. These are reputable, rating agencies who are saying these cars are just not high quality. So with the new guys coming with all these different EVs, you're getting guys who have done this for, in some cases a decade, who, can easily think about, let me finish that thought, sure. Who can easily, go from producing an ICE car to producing an EV car. Think about this, right? So when COVID hit, right, Elon Musk was famous for saying, we're going to make ventilators, right? We're going to repurpose our factory to make ventilators. Did he? No, he didn't make one ventilator. What he did is he brought a couple of CPAP machines, slapped the Tesla logo on them, and sent it to a hospital. You know who did repurpose their facilities? Ford and GM, right? Think about this, World War II, right? When we needed tanks, Ford and GM repurposed their facilities to make tanks, right? These guys know what they're doing. And what's more important is the ICE internal combustion engine manufacturers, they make cars at a profit. They're ICE cars, right? Those cars have profits on them. They're losing money on their EV cars. And I would argue that barring China, Tesla might be losing. I don't think the Fremont factory is profitable. I don't think this is my personal opinion, I don't think the Texas factory is profitable. I don't think Germany's profitable. I think the profit is in China. And if you look at their, you can't tell now with the 2022 10K, but in the 2021 10K, you work the numbers out, they tell you the only profitable facility is China. Why? Because they got a sweetheart deal there. Because you're able to, I'm not saying Tesla's doing this, but in China, you're able to hire slave labor. Everything's cheaper. So, the point is, outside of all the, what I think is accounting shenanigans that is going on at Tesla, the reality is they need to generate cash. And I think that, this year they have to pay taxes in China. That deal gets less and less sweet each year. And I think that making EVs is not profitable right now. But I think the ICE guys can do that. They can make these cars unprofitably because their core constituency of selling ICE cars are profitable. So they can use that profit to invest in the EV space. So I think that puts Tesla at a disadvantage when a lot of people thought Tesla was at an advantage.
So what do you say to people who respond and say, well, Chevy tried with the Bolt to have an EV and they just canned the Bolt.
Right.
It seems like they're cutting jobs at Chevy Cruise, their autonomy division. It seems like most companies, even BYD, are focused on, let's provide some simple ADAS tools that we know will work, like lane keep assist, something we can go to market with, we can bolt on. But most industry reports show that legacy automakers have a $10,000 cost disadvantage in making EVs compared to a Tesla.
Right.
When does that switch? Are you suggesting that the ICE will catch up and somehow they'll get that advantage back?
That's a great point. So if you look at Tesla's margins with the most recent price cut, you're talking probably about 18%, 17 to 18% margins. That would put them below most automakers. All of a sudden, they're not the manufacturing leader. This is already happening. And with respect to GM canceling that car, that's normal, right? So they're replacing that with another EV, right? You introduce new models. I think they're replacing it with another low-cost EV. So while a lot of Tesla fans and bulls come out and say, hey, look at this, they're replacing it with another EV. So I don't think it's them getting out of the business. They're just basically updating the model. And I think with respect to cutting people, look, people are struggling, right? I mean, the economy is not great, despite what some politicians may tell you. So it's not just the car companies cutting employees, right? There's a ton of tech companies cutting employees. There's job cuts being announced every day. So I don't think this is specific to the auto industry. I think it's a more economic thing.
Do you think that could be potentially why Tesla doesn't have that demand elasticity? Going back to one of your original arguments that, hey, you're reducing prices, but it doesn't seem like maybe we're getting as much throughput. Well, at the same time, I think you would agree they are ramping production substantially. Right. Is that maybe more macro? If we were back at, you finance your car for 1.5%, Tesla would be having wait lists.
I think it's partially macro, but you're seeing tremendous growth from guys like GM, BYD, VW, Hyundai, Toyota, etc. in their EV sales. Their EV sales are growing, whereas Tesla's are stagnating despite significant price cuts. So I do think there's a part of it that's macro, but I think there's a big part of it I think Tesla has saturated the market. And I think that people are saying, let me look at something else. It's just competition, right? You have a ton more EV cars available. Before it was just Tesla. Now you have, 10, 20, 30 options with EVs. And I think people are saying, let me try this other car. Let me try this other company. My service at Tesla was horrible. My brother manages a dealership in California. He said someone came in with their Tesla. And this is one person. I don't want to say this is everybody. Sure. But he called me up 2 days ago. He's like, call me back immediately. You got to call me. And I was busy. I called him the next day. And I'm like, what's up? And he's all excited. He's like, look, people are bringing in their Teslas and they're telling me that like there's this scheme that Tesla's doing where, you lease a car and you can't buy it, and then they tell you have to buy a car, and then you go to and they tell you they'll buy the lease back, and then you go to sell them the lease, and the price they told you they would give you, they cut it lower when you go to sell it. So he said there's been a number of people that have come into his dealership saying we want to trade in our Tesla, we'll never buy another one because some of these schemes they're doing. And again, I don't know if that's widespread. This is just a couple of guys in California, but you've heard a number of things like this, right, on Twitter, etc.
I suppose I would say it's very likely that anybody showing up at a dealership with a Tesla does not like Tesla. So you probably have a disproportionate share of unsatisfied people.
Right. That's fair. But just the serviceability has been extremely questionable. And some of their tactics just, that we've seen have been questionable. But that's not the bulk of our thesis. Our thesis is basically competition is going to come in. Competition is going to crush them because they're the BlackBerry of the EV space. They're going to have to cut prices. Margins are going to get cut. And people are going to see this is just a car company. That's the auto industry. Every auto company outside of Ford and all the new EV guys has went bankrupt. Why? Highly capital intensive, extremely low margin. And I think Tesla has been able to stave that off because of a number of things. I think COVID was the best thing that happened to Tesla because you had all this stimulus come in, you had part shortages, and they were willing, I think, to do things that other automotive companies were not willing to do. And I think that brought them a couple of more years. But I think now we're getting back to the mean level of what the auto industry is. And I think that's extremely low gross margins, extremely high competition, and extremely capital intensive. And that is not what Tesla's stock is priced for.
Now, some say that when it comes to Tesla service, there potentially is virtually no service. So do you think that's then unique to just all EVs, or do you think Tesla has a potential advantage here?
No. I think Tesla has horrible service. I mean, that's pretty much.
How are you evaluating that? You don't own a Tesla.
Right. I don't own a Tesla. Thousands of entries into some of these different online forums, a number of entries into Twitter. That I've seen, and some of my friends who have owned Teslas, who have had minor, one of my friends, he's a cultist. He loves Elon Musk. He owns a Tesla. He's in Florida, and he brought the Model S. He paid $75,000 for this car. He's already had to take it in 3 times to get it serviced. I brought a 10-year-old Porsche, and I haven't had to take it in once. So. And when he takes it in to get service, it takes a long time. Now, he won't say anything bad about Elon Musk, but this is a real world. This is my buddy who's having these issues. And I've heard similar issues from other people out there. So, look, I'm not saying that I know everything on what's going on with service, but I think in general, if you go to Google and you type Tesla service, I think the stories you'll see will be quite bad. And I think that's causing demand in the U.S. to waver. And you're seeing that with respect to these price cuts. And despite these price cuts, even today, if you go and check their inventories, they're spiking higher despite, massive price cuts. So it doesn't, I can't say exactly what it is, but something is causing demand for Tesla cars to decline significantly. And again, the stock is just not priced for that. You're talking about a stock that's priced at, Tesla is valued, if you look at their market cap, I think right now, it used to be the next 7 largest automakers combined. It's probably now the next 5 largest automakers combined, despite selling just, I think, 4% of the cars they do. So for that valuation to make sense, they should be selling, their quarter-over-quarter growth should be accelerating significantly. They shouldn't be cutting prices. They should be raising prices, because if they're worth more than the next 5 largest automakers combined, that means demand for their cars should be astronomical. It should be in the stratosphere. And we're seeing the opposite of that.
Is it possible that you're comparing Q1 to Q4, where generally in Q4 you have this rush of demand, and in Q1 you have the seasonal decline in demand? Is that possible?
No, because if you look at what happened with, again, BYD, VW, Toyota, Hyundai, etc., NIO, Li Auto, I can go on and on. They all saw tremendous growth Q4. Not all, but most of them saw tremendous growth Q4 to Q1 without the price cuts, right? Last year when Tesla was cutting prices, BYD was raising prices in China. You understand? So, and they still sold a massive amount of cars, right? They saw tremendous growth. So this is clearly, looking at the data, a specific issue with Tesla. And again, you're talking about now 7 price cuts in the US. And if you look at that, and by the way, the inventory chart I'm talking about, I think it's Matt Jung who keeps the data. Tesla only shows, so for instance, if they have like 100 red, Model S long range cars in inventory, they only show 1. So that inventory number that Matt Jung is tracking, which is going up, is actually worse than it appears.
The service data, to some extent, it sounds largely anecdotal, to some degree like how people, as I started this interview, define you as a bear, right? Like anecdotally, it seems like a lot of your tweets are bearish.
Right.
I think
I'm very bearish Tesla. I think the stock is grossly overvalued.
But outside of Tesla as well, I think you had some frustration in that your reputation is of despair, but you're not bearish everything. You're long gold, long nuclear, which we're going to talk about. Is it possible that maybe the service isn't that bad? Maybe the anecdotes of, I had to go in for service, but how does that compare to cars that get serviced 3 times a year, 4 times a year, regular ICE vehicles?
Yeah.
Whereas Teslas maybe aren't getting service for a year or more. I mean, I can give you anecdotes on the 2 Teslas that I own of maybe in the lifespan of 2 cars over an average ownership of 4 years, I've been at service 4 times.
Right.
That's an average of essentially once every 2 years per car.
Right. Sure. It's definitely anecdotal. There's no doubt about it. But again, the core of our thesis isn't that service is going to hurt Tesla or service is what's going to bring them down. Okay. The core of our thesis is competition is going to crush Tesla.
I see.
And I believe that the data firmly shows that the competition is crushing them. And you're seeing that continue into Q2, right? 6, 7 price cuts in the US. And inventory is still building. Another price cut just today. And the data out of China, again, only 6 boats into Europe, whereas you had 13 last quarter. And still, despite not seeing, over 50% drop in boats, you're not seeing a surge in China sales. That's very concerning. This is just data. So the data continues to suggest that things are very bad for Tesla. You have Elon Musk telling you he's willing to sell cars. Think about this, right? He's telling you he's willing to sell cars at break even. He's going to make up for it with FSD, right? Here's the problem. The FSD take rates have went from 40% to 5%. Only 5% of the people buying Teslas are buying FSD. So how are you going to make up for selling cars? It doesn't even make sense. You understand? So,
and I know the chart you're referring to. I think part of that could be explained by a higher international sale-through rate of Teslas, where you can't potentially buy FSD yet because of regulatory challenges. I was looking at...
Even in the US, though, the FSD rates have collapsed and remain collapsed.
I'll have to look at that. But what's fascinating to me is the Guidehouse Insights chart that you refer to. I brought it up. And they throw Tesla basically in the bottom.
Right.
And everybody else, Baidu, Zoox, Mobileye, Aurora, Motional, Cruise, NVIDIA, Waymo, those are the leaders.
Right.
Now, their evaluation criteria, let me ask you what you think about this. They evaluate these based on the following. Vision, that makes sense. But what about this? Go-to-market strategy, partners, production strategy, sales, marketing, and distribution, commercial readiness. Those items in this evaluation have a similar weight to actually technology of the full self-driving. And all of the items here for a beta product are very easy to anchor down. Is it possible there's a massive amount of bias in these insights? And would you consider risking your life and trying out FSD, confronting Gordon Johnson, and trying FSD to actually compare the technology?
No, I would never try FSD. And again, I've been in a very bad car accident. Okay. I've actually been in 2. So given what I've seen, what I've seen FSD do, by Tesla fanboys, right? I would never risk my life. No, I would not. With respect to them being biased, look, it's, if they had Tesla ranked number one, I'm sure you wouldn't say they're biased. Look, he removed a number of sensors.
Jaded.
Okay, he removed a number of sensors. He removed radar, right, to save costs. It's like, FSD 2.0, FSD, and it's like every single one, you even hear fanboys saying, it's getting worse. And this, you don't have to take my word for it. Just literally go online, type in FSD, and look at the videos. You have cars turning into, lanes, running over kids in tests. You have cars, that are running into, restaurants, etc. I mean, this is crazy stuff. TeslaDeaths.com, you've had 19, according to TeslaDeaths.com, verified deaths associated with autopilot being on. These cars are wrecking into fire trucks. I mean, this is crazy stuff. I believe any other auto company, this is my opinion, that had these issues would immediately recall it and take it off the road. Whereas with Tesla, it's been on the road since, 2016, 2017? In fact, think about this. How do you trust FSD when we now know the painted black video, right? The painted black video from 2016, which is still on Tesla's website, last I checked, was completely doctored. And it was directed by Elon Musk. It was a video over 3.5 minutes. If you watch that video, the start of the video says the driver is only in the seat for legal reasons, right? We now know that his engineers are not wanting him to do that, but he said, let's put that in there. We now know the video was shot over 550 miles. There were multiple disengagements. The car wrecked itself. But if you watch that video, you'll think that Tesla cars since 2016 can drive themselves. That is extremely reckless. And that's the best way I can put it. So to put your trust in someone who's willing to do that with a video, how is that different than Trevor Milton rolling a truck down a hill? How is it different? I don't know, right? Nobody is alleged to have died because Trevor Milton rolled a truck down a hill. TeslaDeaths.com has 19 people and counting that have died associated with Tesla's automated technology. So I think it's extremely reckless what he's done. The reason why I would not test it is because of things like that and other mistruths that Elon Musk has said. And if you watch the Hulu documentary, you have two former employees saying, we left the company because they were making egregious claims associated with FSD. These are former Tesla employees. So no, I wouldn't put my life at risk. And look, we are factoring no legal liability. Our working assumption is that Tesla is above the law. They will never have to be, if they go to court, they'll always win. They'll never be prosecuted for any of this or have to pay for any of this. But if you think about what's happening, it's a real dereliction of duty from NHTSA to allow this stuff to continue. He's testing beta technology that isn't what he said it was in 2016 on the road that has been alleged to have taken 19 lives. I think that's pretty compelling.
Is it possible that Teslas haven't been taken off the road because this 2016 video, which let's agree that the claims were substantially exaggerated in 2016, that's now 7 years ago. Let me finish really quick. I give you a shot.
Sure. Sorry.
So 7 years ago, we have this video that had exaggerated claims. Let's agree with that. Is it possible, though, that Teslas aren't being taken off the road because the accident rate per million miles driven is 5 times fewer than a regular ICE?
Right, so that data from Tesla has been thoroughly refuted, and we now know is not true. NHTSA actually...
Which data? The 2016 data or the million-mile accident?
The million-mile accident data. We now know that data is completely... I shouldn't say completely, but it's farcical because it's comparing miles driven on the highway to other cars where miles are driven in city. It's like you're comparing apples to oranges. So to continue to cite that data when it's been thoroughly disproven, I think is misleading. I'm not saying you're misleading, but anyone who's doing that is being extremely misleading. So it's not safer, number one. And number two, I think the reason why it hasn't been taken off the road is because I think you've seen a dereliction of duty from NHTSA. The NTSB has stated, essentially, this stuff needs to be taken off the road. But they can't act. They can only make recommendations. It's only NHTSA that can act. So, and again, this is all our opinion. But I believe that the reason why it hasn't been taken off the road is because you've had a massive dereliction of duty. And, our assumption is it'll never be taken off the road. That's our working assumption. Because if it is, our price target would probably move lower from 24.33 right now. So again, I think that what's happening is scary. And quite frankly, when I see, given what my research and the years of covering all this and the many mistruths that have come out of Tesla around FSD, when I see a Tesla car on the road, I keep my distance. Because again, when you've been in an accident, a car accident, you don't take any risks.
So clearly, you're disputing the data from Tesla and NHTSA, which
no,
that's
no,
the
I'm not
National
disputing
Highway
it.
Safety.
This has been thoroughly debunked. And NHTSA, I think it's either NTSB or NHTSA has agreed that they were wrong in the way that they conducted their study. That Elon Musk, he uses that the verbiage they use. There was I think it was a New York Times article. I'll send it to you.
Yeah, I'd like to see it.
What detailed that this claim that Tesla's making has been thoroughly debunked. This came out like last year. So this idea that Tesla is safer has been thoroughly debunked. I'm sorry. And there was, I think, a New York Times article on it.
Yeah, it seems like recently in the last Q4 impact report, they're now reporting, now in fairness, it says mostly, but they say autopilot engaged mostly on highway miles, 0.18 million or accidents per million miles, mostly non-highway miles, 0.31. No active safety, 0.68, and then the U.S. vehicle fleet accident rate at about 2 to 3 times that at 1.53. Do you dispute that recent data as well?
No, I'd have to look into the recent data. But I know that the claim you're making with the million miles driven and Tesla being the safest car on the road, that data has been thoroughly debunked.
Well, you mentioned that you were debunking because that was mostly highway, but now they're parsing out even non-highway.
Right. To be honest with you, I haven't looked into the most recent data. Okay. When I say I haven't looked into it, I don't know what the expert opinion is. When I say this has been debunked, I'm not saying by me. I'm saying by the experts. Right. So I'd have to look at what the experts are saying. I can't speak to that.
Would you say New York Times is the expert?
But I'll say this: I do not trust anything. I shouldn't say that, but I'm highly distrustful of anything that comes out of Tesla, given the painted black video, given the 13D instead of the 13G, given he said he was going to make ventilators, he sent CPAP machines, given he said he was going to fix the issue in Flint, he didn't, given he called the guy a pedo, given he said he was going to have 1 million robo-taxis on the road in 2020, given he continues to tell people he's selling more cars than he's producing, where the past 4 quarters he's produced more cars than he's sold. I can go on and on. Given early on, right, the documentary now that is on it's on Tubi, right? We now know that when he did that battery swap to get the tax credits in California, that was also doctored. So there's all these things that he's done, right? That any sane person would say, I don't trust what this guy's saying. So I will say that I'm not going to say I disbelieve it, but I'm saying I need to prove what he's saying before I'm willing to believe it.
It sounds like you don't like Elon.
It's not about not liking Elon. It's just about being a historian, maybe. No, it's just about being a human being, right? If somebody tells you for 5 years in a row that 2 + 2 is 5, right? And then you come to me and say, hey, you want this guy to do your math problems for you? I'm going to be like, no, I don't want that guy to do my math problems, right? There have been a lot of mistruths that this guy has said. The Tesla deaths, credibly alleges, have potentially led to death. So, I think
every car company has, in fairness.
Well, no, not every car company has said, not one car company has said, our cars are driving themselves. The guy is in the driver's seat only for legal reasons in 2016. And every year since essentially 2014 said, we'll have full self-driving, better than humans on the road next year. Nobody said that except for Tesla.
Probably the best thing on the FSD part is for people to evaluate that themselves, I would imagine. And I understand that you've been in an accident, so you're unwilling to test FSD. I did, though, I want to pull up the New York Times thing, and I found it. And you're right. They said, these figures always show that accidents are less frequent with autopilot,
right.
A collection of technologies that can steer, brake, and accelerate Tesla on its own. But the numbers are misleading. Autopilot is used mainly for highway driving, which is generally twice as safe as driving on city streets. Tesla has not provided data that would allow a comparison of autopilot safety features on the same kind of roads. Neither have any other car makers. However, now they have. And so I know you haven't looked at the new data yet, but it would be interesting. The question that I want to frame out of this is it possible that, yes, Tesla may have made mistakes in the past and maybe Elon's been reckless with his SEC filings? Is it possible they can fix these in your mind?
No, because to get to level 5 autonomy, you need LiDAR and radar, and Tesla does not have those.
Who says that?
Well, any experts you speak to in the space. We've spoken to, I don't want to say their names, but we have a number of autonomous driving technology experts we speak to. I think Tesla will never, let me be very clear, this is our opinion. I think Tesla will never, with its current technology, get to level 5 ADAS. It's impossible in our view. They need radar, they need LiDAR. And they're talking about doing radar, but they're not going to do LiDAR. Without both of those, I don't think it's possible to get to what they claim that they're going to get to.
Very fair. So one thing that I want to bring up is you on your website, you have the your research. You were forecasting negative free cash flow. Right. We didn't go negative, but it came in substantially lower than expected.
Right.
And earlier you mentioned some potential accounting shenanigans, like potentially depreciating some of their or capitalizing some of their capital expenditures to butter out how much they're spending. Tell me about their cash position, because they have had cash flow. It's falling. They're spending money on these new factories.
Right.
Do you think that if Tesla does go negative free cash flow and cost of capital is higher now, that would be a big catalyst for the stock going down?
I think it would be one catalyst, yes. But I think that, and again, when we say shenanigans, these are our opinions. There's, when you provide GAAP accounting statements, there's a number of things you need to be able to say definitively. We can't say that definitively. These are our opinions based on the fact that, their CapEx, right, in the first quarter was more, right? In the first quarter of this year, they're not ramping any plants, right? Their CapEx is more than when they were ramping 2 plants last year. We have questions around that. Tesla will not answer our calls. They won't answer our emails. They never let us ask questions on calls. So we don't get our questions answered. So we just have to wonder. But with respect to the cash flow, I think that, if it goes negative, and we think it is, it's going to be bad. Keep in mind, right? If you look at their cash flow and you take away the ZEV credits they sold this quarter, it was negative. It was negative 80 million. First time, I think, since 2021. And keep in mind, a lot of that is because GM isn't selling EVs. I think a lot of the ZEV credits that Tesla continue to sell is to GM. Now GM's about to start selling a lot of EVs. What's going to happen? So I think that's something to be concerned about if you're a Tesla bull. I don't think people are focused on that. So I think there's a lot of risks around the corner that I think a lot of people may be overlooking. But I think the most important thing right now, what a lot of bulls hang their hat on, is unit growth, right? And that's clearly what Elon Musk is focused on, another price cut today. So I think that he told you, right? He told you on the call, we're willing to go to 0% margins on our vehicles, and we're going to make up for it by selling FSD. Again, how are you going to make up for that when you have 5% attach rates? But anyways, a lot of things this guy says doesn't make sense to us, right? He's saying we have more demand than we can make cars, whereas they produce more cars than they've sold for 4 quarters in running, a record. That's never happened. So again, I think that cash flow, I think, is going to turn negative, but I think what people are focused on is units, but I think people are going to be concerned about the margins.
Do you think it's possible that Tesla could release a complete suite of full self-driving? You already said not level 5, but of, let's say, level 2.5, and maybe then start recognizing some of the FSD revenue at a higher
they've already recognized significant amounts. They
haven't broken down how much. They've recognized some. You're right. And
they break it down into the Qs and Ks. They've recognized significant amounts of FSD revenue. Yeah. Keep in mind, FSD is vaporware. It does not exist. There is no such thing as full self-drive. It is vaporware. That's a fancy way of saying it's a product that doesn't exist. The fact that the FTC allows them to sell this is a mystery to us. But nonetheless, it's allowed. So if they released, level 2, 2.0, right? They've been doing that every single, month for the past 5 years, right? 1.1, version 1.6, whatever. And even the fanboys are saying it's getting worse, right? If this quote-unquote dojo computer, or this, the ARK Invest thesis that they're collecting millions of miles of data, which I think is completely farce. It's a complete farce. I don't think their cars are learning. Again, if you talk to the experts, this has been disproven as well. But, you're having the same issues at the same intersections, et cetera, and you're having new problems emerge. So I just think that, FSD is something that was used to, raise money and allow, sell-side analysts to have these farcical, fantastical price targets. And we've said all along that it's not what it's chalked up to be. And we said that, the reason why we said that, by the way, is because 2 years ago, via a Freedom of Information Act request, there were documents that came out between Tesla's lawyers and I think the California DMV, where in that communication, right, Tesla lawyers said, our FSD, our autonomous drive is level 2, and it will always be level 2. That's what they said in those documents, right? The problem was because the stock was going up, we were reporting on that, nobody cared. They're like, no, you're wrong. You're just a hater. So, look, I think that, this FSD hope is something that can continue to keep people, engaged and happy about the stock and hopeful. And that's great for Elon Musk and Tesla. But the reality is the competition has passed them, everyone, according to Guidehouse. And, with their current technology without LiDAR and radar and taking sensors out, they'll only ever be level 2. So until he fundamentally changes, I don't think he's going to achieve FSD. And Elon Musk himself said, if we don't achieve FSD, Tesla is a $0. He said that. I didn't say that. He said that. I'm not saying that's our belief, right? We have a $24.33 price target, but
so more than zero. Hey, you're a bull.
Yeah, I mean, but the problem, it's just, if you put a 7 times multiple on, earnings that are fair, that's not how we value it. But
sure.
You're talking about like a $20 stock.
So you don't buy at all the Cathie Wood, Brett Whitten argument of let's price in some degree of robotaxi.
Cathie Wood, I don't want to speak ill, but what I'll say is, we had a debate. I think we debated her. It was Montana Skeptic and I debated her at the Robinhood conference. I think it was in 2018.
I got Robinhood socks on.
Nice.
They were free.
Nice. I love the conference. Those are nice socks.
Thank you.
But her thesis then was robotaxis. It's all robotaxis.
Yeah.
In 2019, they're going to be doing billions of dollars of revenue. They haven't done one. There's not one robotaxi on the road. So she got lucky, in our view, GLJ Research's view, because of COVID hit. You had all this massive amount of money that was dumped into the market, and every stock went up, right? AMC went up. Every stock went up. Tesla was the leader of the MEMS, and because the stock price went up, it was like her thesis was validated, even though her thesis has been 100% incorrect. If you look at her Tesla model, it's riddled with holes and mistakes. And when these mistakes are pointed out, as we recently did on Twitter, we get no response from Brett and Cathie or Tasha. And this isn't talking ill of them. I'm just saying, we make a small mistake, right? We got the cash flow number wrong. You highlighted that. She says they're going to have 2 million robotaxis on the road. There's not one, and yet nobody talks about it. So, I think that, her models are, I think, incorrect. I can tell you where she's made huge mistakes. And I think that, when you go out and you say, pre-split, she said it was a $2,000 stock. Now, post-split, she's saying it's a $2,000 stock, right? And you put these fantastical price targets out there, you attract attention. And,
So you think maybe it's more marketing than...
I think so. Because...
Selling the sizzle before the steak.
Well, just think about it, right? Her bear case is like what? Like a 500% upside? So it's not realistic. But think about it. Cathie Wood... If you ran a hedge fund, right? Look at what her performance over the past 2 years, and you had that performance, you'd be out of business. She's raking the dough in, right? Because she can say we're going to grow 50%, whatever her number was. It's like 50% every year, and people get excited and give her money, and then she charges an exorbitant management fee, and whether she's right or wrong, she makes money. So I think that the marketing is a big part of it, and it's unfortunate because those people could be allocating their money to money managers who are performing, which I think would benefit them.
2 more Tesla questions, and then we'll move on. You tweeted that when people find out in 10 years the battery is dead, by the way, with your, emoji here, that in 10 years when the battery is dead, the replacement cost is $30,000 to $50,000.
Right.
Where did you get that number from?
That was wrong. I think the replacement cost is around $10,000 to $15,000.
Okay.
Sometimes we're not 100% accurate in our tweets, but the point is, this is another thing we saw on Twitter. There's used Tesla cars. Let me not say that because I forget the exact point. But the point is, a used EV is not worth as much as a used ICE. My car, right, is going to last me. It's 10 years old. It's going to last me another. It's a Porsche. It's going to last me another 20 years, right, if I wanted to, if I take care of it. Your EV car, that battery, when it goes out, you're going to have to replace that. And that's a replacement cost of $10,000 to $15,000, right? You and me, that's fine, right? You more than me probably, but we can afford that. But the average American cannot. So forcing an American to take an EV without them understanding that cost, but more importantly, once these cars are used and that knowledge is widespread and well known, the used value of EVs is going to collapse, and that will hurt the new sales of EVs. So that's the point we were trying to make.
Last point on Tesla, because you're very clear on Tesla.
Right.
But the last point you mentioned that they haven't come out with new models. Cybertruck.
Right. I mean, so, right, think about this, right? So when they did the Cybertruck launch, right, what is it, like 3 or 4 years delayed now? So when they did the Cybertruck launch, they were saying it's going to be a $40,000 truck, right? We'll see if that's right. I think it's probably going to be double that price. I personally think it's not that great looking. Given the issues they've had with their cars, I think the specs are going to be significantly different. The price, the range, etc., are going to be significantly different than what they've promised. So I can't predict the future. But what I can say is when they announced that truck, we said the day they announced it, there's no way it's going to be that price, and it's going to be delayed. And we were right. So we'll see what happens. But I think that this idea that they have all these orders and that all these people are going to buy that truck, I think it's going to significantly underwhelm. So we'll see what happens.
Next topic, you talk about housing burst 2.0.
Yeah.
What do you think? We've seen housing prices fall from about May to December, nationwide average around 10%. Some areas have been, the Phoenixes have been more like 20%, Austin. Right. How is that going to affect this economy?
That's a great question. So, we're currently renting, but you think about it, right? A lot of the spending patterns in the U.S. are driven by housing, and more importantly, how much you think your house is worth or how much it's worth. So we've seen housing prices fall for the first time, annual housing prices fall for the first time in a long time, right? Mortgage rates are up. The cost of a house is up significantly. Why? Why is it up? Because the Fed brought mortgage-backed securities and they never stopped since 2009. That literally they're printing money out of thin air and buying houses. That's the way to think about that. Sure. That is unfair to young people who are trying to buy houses, right? It's great for people like you and me who, not me anymore, but I used to own a house. It's great for us because our asset value goes up. Sure. But this is artificially boosting the price of houses. Now, you have mortgage rates, 30-year fixed mortgage rates that were what? 2%, under 3% not that long ago. Now you're talking about just under 7%. It's just a matter of math. It's just more expensive to have a house. So what happens is it's more expensive to have a house, right? People are making literally the same amount of money. Mortgages are more expensive. So you're going to have less demand. So what I think has happened is, and this is proven in the data, you have a lot of people during the housing boom that brought second, third, fourth homes as investments. And I think right now they're keeping those houses off the market because they think we're going to go back to the euphoric period. But if you think about the last housing bust, right, 2007-8, what happened was the decline in prices started in the East, right? You're talking about places like, Florida, basically the East Coast, North Carolina. Yep. And then the people in the West didn't see it. They said, hey, we're going to be fine. It's not going to hit us. And then it hit them. Slowly worked its way. Sure. Now it started on the West. And I think it's going to work its way to the East.
Interesting.
And I think it's just math. It's just that it's more expensive and you have thus less demand. And as prices start to fall, right, from peak to trough, I think San Fran's down I think 16%. A lot of places are down, a little less, a little more than that on the West. Yeah. And those declines are starting to pick up. So I think what's going to happen is, price declines are going to start to fall more. And once those people who are holding that inventory off the market put that inventory back onto the market, that's what happened in the global financial crisis. There's like 3.5 units. If they put just I think 10% of that, 20% of that back onto the market.
This is of the vacant properties.
Not vacant. It's properties. It's not even necessarily vacant. It's just properties that are being held off market.
Okay, for whatever reason.
Correct. Okay. Let's say you own 3 houses, right? Sure. And clearly you're not staying in all of them. Maybe you're renting a couple out. It doesn't matter. But you're not putting them on the market because you think prices are too low, right? But let's say you're in Phoenix, and all of a sudden prices are down 10%. Now they're down 20%. You start to panic. What happened in the global financial crisis? People started to put those houses on the market, right? More supply, same demand, prices fall.
Yeah.
More supply, same demand, prices collapse.
Oh yeah.
So I think that is what could potentially happen. I don't know if that's going to happen, but that's what the data is suggesting. And if that happens, how does it affect the economy? When the value of your house falls, right? In your mind, and rightfully so, your wealth falls. And when your wealth falls, you stop spending as much. And when you stop spending as much, the economy is affected.
Yeah, the wealth effect, of course. So you think a big risk to real estate right now is the potential collapse or the rise of inventory? Because right now we have very shallow inventory. In fact, the first quarter, much like we saw a very seasonably warm January, which led to retail sales blowing up, potentially due to seasonal adjustments as well. We've seen some markets tick up again in the first 3 quarters. Will that flip-flop back down when inventory rises, if inventory rises?
Right. So I think the seasonal the blip we saw, I think, is somewhat seasonal, but it's also because, remember, rates fell. Mortgage rates fell a little bit, right? They went from 7.3 to, I think, 6.4.
Yeah.
And that creates a lot of demand, right, at the margin. But again, with inflation now trending back higher, right, with the Fed telling you we're going to raise rates 2 more times and keep them there for a long time, and yet the market's saying you're going to cut rates 2 times before year end, I think there's a mismatch. So once rates correct to what the Fed is going to do, rates go back higher, mortgage rates go back higher, I think you're going to see a further lull in the housing market.
What percent downside do you see in housing? And then what does that translate to in stocks?
That's a good question. That's a very tough question. I would just say, the last housing crisis, I think peak to trough, a lot of prices were down 40 to 50%. And I think we'll see something similar. I would say, look at where prices were pre-pandemic and look at where they are now. And I think we're going to go at least to where we were pre-pandemic, but typically prices undershoot.
Back to trend or even below that trend?
I think it's going to go back to where the price was, not even trend.
Not even trend. Back to where it was in 19.
Where it was and potentially lower. And if that happens, I think that it's going to have, I don't know what the effect is going to be on the stock market, but I think it's going to have a profound effect. I would say, we could see the pre-pandemic prices, the pre-pandemic lows. That's where I would probably get a lot more bullish on everything once the S&P got down to that kind of pre-pandemic level.
Wow. Would you do that with individual stocks? If, let's say, Amazon or Google are at pre-pandemic levels, would you consider picking those up?
Absolutely. Everything. Okay. Once we get back down to those pre-pandemic lows, those scary lows, Fed doing quantitative, QE infinity, you got to get bullish stocks. Okay. I'm not saying you have to, but I'm saying you have to reevaluate your position if you're a bear.
So if you trade, it seems like regularly. I mean, as we were setting up here, it sounded like, not that I was listening to everything you were saying, but it sounds like you're working trades, right? You trade. What do you say to somebody who doesn't trade? Right. Somebody who's long and says, you know what, look, I want to buy some stocks that are going to be great in 10 years.
Right. I'm a long-term investor. I want to make that clear. Okay. There's some positions that we trade around, but I like to stay in stocks personally, 6 to 12 months. That's my time frame.
6 to 12 months is your long hold.
Listen, here's the reality. This is a fact. Two great books I want to recommend. This is kind of out of left field. Reminiscence of a Stock Market Operator.
Say that again. What?
Reminiscence of a Stock Market Operator and The Intelligent Investor. Great books.
Great, yep.
Reminiscence is from a guy who was extremely successful in the stock market from like 1900 to like 1930. But if you read it, like everything that happened back then, it's happening right now.
Wow.
So my point is, with respect to the stock market, I do think that there's going to be ups and downs, but with respect to over the next 10 years, over the long term, the stock market's going to go up, but I think there's going to be huge fluctuations,
including Tesla.
Well,
I'm just kidding. You don't have to answer that.
No. Again, I firmly believe Tesla's going to hit our price target, and when it does, we'll reevaluate. Okay. But you have to be nimble because we've had 10 years of artificially repressed interest rates and quantitative easing. Essentially, the Fed printing money out of thin air and buying stuff, and what people will say, rightfully, what a bull will say to me is, Gordon, why are you worried now, right? We've had this stimulus for so many years. Here's why I'm worried. We now have inflation higher than it's been in 40 years. That's a big change. That's something that we haven't had over the past 15 years.
Even though it's fading away.
But it's not. It's now on the uptrend. Again, if you look at the non-seasonally adjusted CPI, it's now trending up. And you saw a hockey stick in 2021 that's still going up, right? It was going like this, and then at the beginning of the year when crude fell, it went like this. Now it's going back up, right? So I think that's a concern. And again, the data today kind of supports that. Month over month, we're accelerating. So I think you got to be nimble. And the reason I suggested those books is because there's a lot of lessons in those books as to what's happening now. Look, this market is extremely unpredictable. I mean, you had, multiple years of, put it this way, when the Fed did QE infinity, right? When they did that, right? The risk reward was pretty easy owning stocks. But now that you've had, the Fed funds rate go from 0 to 5 in short order, right? You had a bank that had been extremely nefarious and incredibly alleged to be engaging in illegal activities, effectively bailed out, right? Which is, it's just, you don't know what's going to happen. Like what happens so my point is, it's extremely hard to make money in this market. But I think long term, you find the companies that are trading at decent multiples, not 60 times like Tesla. You're talking about 5 to 6 times, or whatever the industry multiple is. Hopefully around where their peers are. That generates cash, and that is a business you believe in. And I think if you invest in that, you'll do okay.
Do you try to? Would you ever consider like a PEG ratio? So taking that PE dividing by growth, or do you solely focus on PE?
No. There's actually a chapter in The Intelligent Investor where there's a number of key points you want to look at before you invest in any stock. Okay. And I'm not saying you apply each one of those points.
Course. Yeah, sure.
But I like to buy low, sell high.
Right.
And a lot of these stocks are trading at generationally high multiples, and those are the stocks we try to stay away from.
Okay. A couple more topics here. We'll do energy, crypto, and final question. We'll wrap up. So you have some strong theses about energy, solar. It doesn't sound like you like First Solar. The Chinese have really substantially taken over solar manufacturing. They did a great job, actually, I think. I mean, from 2013, they got from zero solar to basically now dominating the world, and they've got some of the best technologies. What's going on with the energy market? Is this going to be a short-term blip here in energy stocks, a buying opportunity, or long-term screwed?
When you say energy, I assume you're referring to solar specifically.
Let's do, let's start with solar.
Okay, so with solar, the solar stocks are trading at, in our view, what are ridiculous multiples. Okay. And the reason that is because last year, due to the push by people like Larry Fink at BlackRock, et cetera, on ESG investing, forcing money into that space, as well as a lot of talk around the Green New Deal, and then Build Back Better, and then finally the Inflation Reduction Act. I think, and this is our phrase, I think the analysts in the space, for the most part, are criminally bullish.
Oh, wow.
And what I mean by that is, First Solar just reported earnings. Last time I checked, the stock's down 10% today. We told our clients, we're like, listen, we've seen this before, right? We saw it with Obama. When Obama got elected, over Obama's full presidential term, 8 years, the Solar 10 index fell 78%. Wow. You would not believe that, right? Yeah. Why? Here's why. When he got in, the stocks went up like gangbusters. Why? Because he said, we're going to do solar. Sure. We're going to introduce all these incentives. He did. And people, the sell side, they were creating these like fantastical future projections. I remember one of the key theses was, every single airport's going to have a solar panel on it. And they create these like fantastical projections. But you think about it, right? The U.S. is not the biggest market in the world. And just because you give me, my neighbor, right? Let's forget it. I don't mean that, but let's say somebody in the neighborhood, right? You give them a 30% tax credit, but what if they're going through hard times? Are they gonna? They're not gonna buy the discretionary $30,000 to $40,000 solar system.
Sure.
So our point was to our clients, people are making fantastical projections. They were doing that all last year, which is why the stocks ran up. And now these companies are reporting earnings. Enphase is down 26%, right? First Solar down 9%. Jinko down 10% today. They're reporting their earnings, and the earnings aren't matching up to the fantastical projections. I've been covering solar longer than I'd like to admit. I'm embarrassed. I've been covering solar since 2007. So I've seen these cycles where people get extremely excited, and then reality meets the road. And I think reality is going to meet the road this year. But the other problem is solar doesn't work. And what I mean by that is you cannot replace distributed baseload fossil fuel power with intermittent peak load solar/wind power. And the reason is because, the EIA used to put out these grid parity analyses, and they were saying, solar power is equal to the cost of fossil fuel. And that couldn't be any further from the truth. Yeah. And in fact, if you call the EIA up, they'll admit that now. They've included, transmission costs, brownout costs, et cetera. Solar is exorbitantly more expensive. And the proof is in the pudding. Look at California. Yeah. Look at the cost of power in California versus the United States. It looks like this. California, same with Germany. So I think solar is a good short this year because you've had the stocks run to fantastical levels based on projections that are ridiculous. And I think longer term, the reason why we like nuclear is because if you believe that we need to move towards zero carbon electricity, solar is just not a real solution. Think about this, right? Merkel pushed solar on the European Union, right? Solar and wind. And they went all in on solar and wind. And what happened? They shut down their coal plants, they shut down their nuclear plants. But what really happened? They became reliant. They're importing power in from Russia. That gave Russia the power, literally, to start a war because they knew they could do it and they would still have to buy power from them. This is dangerous. Energy security is dangerous. I want to give you a statistic here. A lot of the politicians talk about how, people are, CO2 emissions, people are dying. So let's see here. Deaths. So since 1920, deaths each year from natural disasters have decreased over 90%. And one of the key reasons this has happened is because we're investing in things like, fighting, rising sea levels, etc. Let's see here. CO2 emission. Hold up. That's not the stat I wanted to give you. Hold on. Let me find this stat.
And then I'll also, while you're looking for that, I'll ask you about batteries, because that seems to help with that intermittentness of solar and wind.
So let's see here. Sorry. I can't find the statistic, but for instance, one thing I wanted to make sure I got in there. So think about this, right? So the world has invested $4 trillion overall in wind and solar over the years. Mm-hmm. And right now the world gets 3% of its power from renewables, right? Mm-hmm. And Elon Musk's Master Plan 3, he's saying with another $10 trillion invested, the world's going to get 97% of their power from renewables. Do you realize how ridiculous this is? Do you understand what I'm saying?
Well, based on the numbers that you gave, I'd have to break them down, but based on the argument you're making, that sounds ridiculous.
Right. So one thing I want to highlight, right, and I'm going to read from my notes if you don't mind. So we're spending trillions of dollars on solar and wind, right? Let me give you a statistic. So in the Netherlands, right now, the Netherlands sits 2 feet below sea level, right? But because over the past 500 years, they've invested $10 billion, right? $10 billion over the past 500 years, they've prospered, right? So my point is spending all this money on solar the right way to spend it? So if California focused the money that they're spending on solar on forest fire prevention or nuclear instead, would it be money better spent? Folks in the Netherlands have spent $10 billion over the past 500 years, and despite currently being 2 feet under sea, they're flourishing. In fact, there was global sea levels have risen 1 feet over the past 100 years, and everybody in the Netherlands is fine. Humans are amazing at adapting, but sending trillions of dollars to China for solar panels, I think, is a huge waste of money. In fact, the airport in the Netherlands right now, the airport was the site of a naval battle. So these fears that, oh my God, Florida's going to sink under the water. If we invest in prevention versus Chinese solar panels, that's proven to be the way to go. And I think that the money that's being wasted on solar right now is potentially setting us up for disaster. Do you understand what I'm saying?
Oh, yeah, I absolutely do. I also agree with your argument on sort of a household level that in these more challenging economic times where homeowners, who are obviously have to be a homeowner to install solar, homeowners are going to be potentially under more stress than, let's say, a minimum wage worker who's seen their wage rise 50%.
Right.
Yeah, you're probably going to see less investments in those $30,000, $40,000 projects, especially, and actually to somewhat reiterate your argument, despite the fact that I actually like companies like Enphase, out of the solar panels, right? They're into batteries and inverters. One thing that you're right about is with the new net energy metering plans, you basically have to get solar and a battery. But that now makes your entry cost twice as high for getting in. So yeah, I actually think you're right. There's a reason to be short-term bearish.
Yeah. I mean, the only battery attach rate we have is from the California Solar Initiative, CSI, and none of my peers track that data. It's extremely hard to parse through. I had to hire a data engineer out to do that. But the point is, the battery attach rates are collapsing.
Well, it's supposed to be going the other way. Okay,
right? This is just the data.
I'd love to see that. Yeah,
and the problem is nobody's tracking this data. But you're seeing it, right? Enphase, their battery numbers were horrible. The same thing with the other solar companies that have reported earnings that sell batteries. So it's just simple, right? It's like people are hurting more economically. You're talking about a $30,000 to $40,000 discretionary purchase, solar panels and batteries. You're not going to see people buy more of that when the economy is getting worse.
Yeah, and Enphase has this argument, and I have a feeling I know what you're going to say, but I'll give you a chance to say it. Enphase has this argument that, we sell to wholesalers, and in Q1 we tend to have a very lagged sell-through. Wholesalers have inventory, but in addition to that, because the cost of capital has risen so much, a lot of the wholesalers are trying to reduce their inventories, therefore maybe ordering less from Enphase. Enphase thinks this is that Q2 will be the bottom in that. What do you think? Is that
right?
farcical?
But these same companies were telling you when they reported, Q3 numbers, that you were going to have this massive demand pull-in ahead of NEM 3.0 taking effect in California.
Sure.
It's like everybody's completely forgetting what these companies told you just 3 months ago. You were supposed to have huge beats in Q1, right? From all the solar companies, because that's why when they report earnings, the stocks are actually falling, right? Because because of NEM 3.0 taking effect in mid-April, the Q1 numbers were supposed to be out of this world. And now they're actually coming in disappointing. These guys are like, oh yeah, it's going to be better next quarter. Look, I've covered solar forever. Again, embarrassed to say how long. And the reality is, if you go back to 2009 and 8, when things get worse, these companies get more aspirational. The marketing gets worse. So I think the reality is it's too expensive. And if somebody's honest with you, call somebody to your house who's honest, right? Doesn't care about stocks, and say, hey, should I buy a battery or should I buy a generator? And see what they say. Interesting. 10 out of 10 times they're going to tell you to buy a generator because that solar battery, when your power actually goes out, is going to give you maybe in 2 hours of power, whereas a generator will actually give you real power. It's just the technology's not there yet, and it's exorbitantly expensive.
So short-term bearish or forever bearish?
Let me give you statistics. So it would cost $100 trillion, right, and take 400 years to build the batteries, lithium-ion batteries, current technology necessary to power just Europe through it this winter. That's from the Manhattan Institute. To move every car on the road to EVs, the world would have to double its grid capacity, costing trillions. That would send, basically, when you're talking about 100 trillion or trillions of dollars, you're talking about hyperinflation pretty much everywhere, right? And by the way, no one's doing that right now. If you covered the entire continent of the United States, according to the Manhattan Institute, with solar panels, it would power less than half the country. So the math just doesn't work. So the battery technology is not there. We've said this for a long time. We said that, the reason why, Enphase trades where it does and SolarEdge trades where it does is because, these batteries were supposed to explode, right? It was supposed to start happening in Q4. Then it was going to be Q1 because of NEM 3.0. Now that it's not happening in Q1, it's an inventory thing. It's going to happen in Q2. They'll tell you this as long as their stock is up, right? This is our opinion. But it's not happening. And it's not happening because it's exorbitantly expensive and it's extremely inefficient. And if you don't want to take my word for it, call a solar installer who's honest, right? Ask the guy who's actually, the guy who's not trying to sell you a panel. Ask the honest guy, maybe the guys who come install and say, hey, should I do a generator or a battery? And see what they say. They'll tell you the truth.
You're called the Generac sales folks because they offer both. They offer batteries and solar. All right. Last question. Let me do a really quick rapid fire, and then I have the last question. So really quick rapid fire. Bullish or bearish crypto?
Bearish crypto, let me tell you why.
Okay.
Number one, the tech doesn't solve a real problem. It's simply used to speculate. Number two,
you got this one written out. Okay.
Number two, it's not a real currency and can't act as a functional currency. Why? Because there's a fixed supply. Anytime in history where you've had a fixed supply currency, it fails tremendously. Number three.
Wait. That's a big claim right there. You're saying because people argue that the value of Bitcoin is that it has a fixed supply. You're saying if it has a fixed supply, it's going to fail.
Let me explain.
Yeah.
So let's say you have a fixed supply of dollars, right? And the economy goes into a tailspin, right? For instance, we had COVID, right?
Yeah, sure.
What did they do? They printed money
of course.
To save us, right? They needed to do that, right? I think the initial $2 trillion was understandable. I think it was too much.
CARES Act, the original CARES.
Right.
Okay.
But if you have a fixed amount, you couldn't print anything.
Yeah, well, that's true.
It wouldn't work. Okay. Number three, all cryptos are unregistered securities. And number four, private currencies have always been disasters. I'll talk about the problem, the wildcat banks of the 1937 and 63 timeframe. These so-called wildcat banks, the issue was their reserves were not verifiably backed. Thus, they were subject to runs in which customers couldn't access their funds. Every time in history where you've had a different form of currency, it hasn't worked. So for those four reasons, I think crypto is literally worthless outside of speculation.
Wow. That goes for all Ethereum, the derivatives, yes. DeFi.
I agree with Munger. It's like rat poison. I think it's purely speculative, and you can see that, right? Bitcoin essentially moves with the Nasdaq. Can I go to Burger King right now and buy a burger with Bitcoin? Can I buy a car with Bitcoin? You understand? Like it's literally ludicrous.
But in Ecuador, you could.
This is what happens. This is what happens when you print trillions of dollars. You print 300 years worth of dollars in 2 months. You have stuff like this happen. You have pictures being sold for millions of dollars, NFTs. I mean, this is just crazy stuff.
The last question is a little, dare I say, out of left field. But it's from your Twitter. You quote tweeted this from Black Millionaires Steve Harvey explains what's wrong with this young generation of men today.
That was today, yeah.
Yeah, this young generation of men today asking what women bring to the table. This is very Andrew Tate-esque, right?
Right.
And his response was, a woman can make another you. So I want to ask you, where is your mindset on this Andrew Tateism that we're seeing now?
Yeah, I don't know if I'll comment on that, but my point with that is I just think that, I just think that men need to step up. And I'm old school. I was, I'm a little older, and my parents were alive during the times of, when Black people in the U.S. were fighting for their civil rights, and I think that men should step up and take care of their families and their kids. I have no view on Andrew Tate. I'm not going to go there, but that was the point of that.
Okay.
I think it's a good thing for men to step up and take care of your family.
Very nice. Anything else that you'd like to add?
This was great. I thought, really when I sent you the tweet, I thought it was going to be confrontational. This has been great. You've been extremely nice, even off camera. Thank you. This
is amazing. Shout yourself out. How do people follow you and your firm?
We're GLJ Research. You can see our website, and I think everybody knows our Twitter address.
Perfect. Awesome. Right. Well, look forward to seeing you again in the future.
Absolutely.
Thank you so much. It was a pleasure.